Thank you, all of you, for that. That was fascinating. So now we're going to turn to our final panel on current economic issues. If I can ask Ben Bernanke, Michael Boskin, Maury Obstfeld, Joe Stiglitz, and Alan Murray to come up here. I spoke earlier about how much I learned from members of the CEA and people with PhDs in economics. But I learned a lot from Alan Murray when we worked together at the Wall Street Journal. And so I'm really glad to have him back here. I also know how good Alan is as a moderator, so I made sure that I moderated before him so I wouldn't have a bad comparison. Ben says he'll be right back. I think the more remarkable thing about the people on this panel is that if you were listening to their accomplishments, CEA chairman would be only one of the incredible things on their list. Ben Bernanke, of course, was in the CEA chairman for George W. Bush and later chairman of the Federal Reserve. Michael Boskin was a distinguished economist at Stanford, was in the George H.W. Bush administration. Maury Obstfeld, who was in the Obama CEA, is now chief economist at the International Monetary Fund. And Joe Stiglitz, who was CEA chairman in the Clinton administration, also won a Nobel Prize. So it's really a testimony to the incredible strength of the institution that the people who have led it over the years have been as distinguished as these four men. Alan.
David, thank you, and hats off to you for putting together a truly remarkable event. It did occur to me sitting here for the last couple of hours that this incredibly distinguished group of economists is much more entertaining and insightful talking about history than I ever remember it being talking about the problems of the present moment. There may be an explanation for that, I don't know, but now this panel
you weren't
is
exactly long on jokes either, Alan.
now this panel is turning to current problems, and I guess I get to play the president here. There are five big mysteries about the current economy that I'm hoping this very distinguished group coming from very different perspectives can answer for me, and I hope we have time to get through them all, and we'll leave time for a couple of questions. But let me start with the first. And that's the fact that I spend my days talking to business leaders who tell me that technological change is happening faster than it ever has in their business. Doesn't matter what business they're in. And that if you put together sort of mobile computing, the cloud, inexpensive sensors they can put on everything and collect massive amounts of data that they can analyze, and artificial intelligence, that you and advanced robotics and nanobots, that you have something going on that Klaus Schwab at Davos called the fourth industrial revolution. And so I'm told day after day how amazing this is. And if you look at the productivity numbers, there's nothing there. It's not happening. The productivity numbers aren't growing. So mystery one is the productivity mystery. Why is it that we have all this talk about the rapid pace of technological change, and yet in the productivity numbers, we see nothing? And of course, productivity ultimately drives economic growth and living standards and all the other things we care about. And Michael Boskin, since you were giving me a hard time, you have to go first.
Well, first of all, I think it's important to remember for most of history, it took a long time for technological inventions that would eventually be substantially responsible for increasing productivity to disseminate through the economy. It took half a century for half the factories to be electrified. One of the greatest economists of the 20th century, Bob Solow, said, we see computers and IT everywhere, and it was showing up everywhere but the productivity statistics, but eventually it did. So the past isn't necessarily prologue, but it may be that part of what's going on is the combination of demand factors in a sluggish global economy, a variety of other institutions mean that the pace of some diffusion is slow. It's also important to recognize that a lot of what becomes really important commercially isn't the first thing, or let alone the main thing, an inventor or the firm that rolled it out was trying to accomplish. Marconi's wireless transmission was to compete with a telegraph. He never envisioned mass broadcast radio. Edison's most famous invention, most original invention was the phonograph, and he sued to prevent it from being used for music. So you've got to be a little careful about those things. That being said, I think that there's been a barrage of criticism of the productivity data, that there's a lot of measurement error. And that,
Michael, they're having trouble in the back, if you can.
okay, and
yeah.
that Bob Gordon, in his book, for example, is overstating the degree of slowdown. I've taken a pretty close look at that, and I think that accounts for a very small part. So I think we've definitely been on a productivity growth slowdown. And I will say that the most important thing to remember, in my opinion, is if we stay in a productivity slowdown, it will become even more important to develop policies which are more conducive to productivity growth.
So at the end of the day, are you an optimist or a pessimist about?
I'm a cautious optimist, not like all my friends in Silicon Valley around Stanford who are wildly enthusiastic about the latest this or that. But I do believe if you look at the fundamental science of what's going on, tends to lie behind all this stuff, which was mostly chemicals in the late 19th, early 20th century, then physics. I think first of all, we're turning in part to biology. And a lot of the improvements we're going to have are things that will be valuable and are going to be very important, but it'll be dealing with an aging population and around health. And those are going to be things which are going to be devilishly difficult to measure. So I think that's one thing. And also the technology makes it harder and harder to figure out ways to actually measure what's going on. A lot of stuff's given away free, for example.
Anybody want to take a different stab at that before we move on to mystery number 2?
Well, can I just finish with one last comment? With one last comment. On the basic science, we've heard a lot about these things are drying up. First it was oil. Well, we're kind of now in a huge oil glut. So that fracking, before that 3D seismic imaging, put the light of that, which only became valuable when prices got high enough to make them valuable in the short run by using those technologies. And more recently, we've heard that Moore's Law was running out, that this every 18 months or 2 years doubling of the capacity of chips would eventually slow, and that would be a limiting factor. But we've now turned to 3D chips. Yes, they're more expensive, but not in proportion to the increase in power. And also, when I talk to the people in the software side of this in academia, particularly at Stanford, they say that the hardware side was moving so rapidly that they didn't have to spend a lot of time developing really advanced methods, software methods to handle multiple chips. But that is certainly conceptually doable. It would be hard, but that will be the next frontier, and they think they can tackle it. Now, again, I've also learned to take scientific and engineering researchers to be among the most optimistic people about their own research of anybody I've ever met, so it'll probably take longer. But I do believe we have an opportunity to have much higher productivity growth than we've had recently with a supportive policy environment. I'm more cautiously optimistic than Bob Gordon or Larry Summers.
Okay, let me just say a few words. I mean, obviously, there has to have been a productivity slowdown after I was at the CEA chair. So that goes without saying. And I guess you were agreeing about good policy. And very exciting announcement today about gravity waves. Nobody are quite sure what the practical applications will be, but clearly it's going to change our lives. But that speaks a little bit to the disjunction between business people's view of what's happening and an economist's view. So if you're making a lot of money from Google or Twitter. They're great advertising engines. But the question is, and they have the value of social media. I don't want to underestimate that, and it does improve the quality of life. But the question is, a lot of their income, when they're getting a lot of profits, is just profits that are shifted away from conventional media. So you can't, they're rightly enthusiastic, and so would I be if I were becoming a multi-billionaire overnight. But you can't confuse that ability to become a multi-billionaire with the net increase in the productivity of our economy. So let me stop there.
Yeah, and we'll come back to inequality, but it sounds like you're a cautious pessimist, where Michael.
I guess I say I'm a cautious pessimist. Yeah. That's right. Now, I find Bob Gordon's argument that there's nothing as important as electricity somewhat convincing.
Yeah. All right. Let's move on to the second mystery, and Ben Bernanke, this one is for you, and the mystery is inflation. We now have unemployment. Well, we're now at what used to be considered full employment, and yet there's no sign of inflation. There's no sign of the expectation of inflation in the financial markets. And I'm sort of wondering, actually, I had the great honor at the London School of Economics of being there when Janet Yellen was on sabbatical, and she taught my macro course. So I have seared in my memory the vision of her drawing the Phillips curve up on the blackboard. I told Alan Greenspan that when she was first appointed to the Fed, and he said that's the worst thing I've heard about her yet. But but the question is, where is the Phillips curve, and what are we supposed to think about this inflation that keeps coming but doesn't ever arrive?
Well, if I had to talk in a theoretical way in Janet's class, I think the Phillips curve is probably still the best general framework for thinking about inflation. The problem is using it in a practical way to forecast inflation. Obviously, people have talked about, for example, the key concept of the NAIRU or the natural rate. There's a lot of disagreement right now about whether we are at full employment or whether other indicators other than the U3 unemployment rate are better measures of the amount of labor slack, for example. I think one area where economists really have not done a good job is explaining inflation expectations. So the only thing in the Phillips curve, essentially the only thing that determines inflation over the long run is what inflation that is expected. So it's kind of circular. With rational expectations, you have all kinds of technical issues about finding the equilibrium and so on. More realistically, we believe there's various kinds of learning and adaptation going on. But right now, I think a lot of the debate is tied to the question of whether inflation expectations are in fact anchored close to 2%, in which case then the Fed is right, that as the effects of oil prices and so on work through the system, we'll begin to see movement towards 2%, or are inflation expectations somehow at least partly unanchored? I think those are the kinds of practical questions that make the Phillips curve an imperfect framework.
And the answer to that question is?
Which one?
Which of those is it?
I don't know. If I knew, I would certainly tell you.
Yeah. Did you say you would certainly not tell me, or are you?
No. I'm a believer in truth. I would certainly.
Maurice.
Yeah. Well, your question, the way I heard it, was implicitly about the United States. So I would just want to signal that if you look globally, and I'm not talking about Venezuela, but if you look at, they're not having a deflation problem, they're having other problems. But if you look globally, especially across advanced economies, but also at a number of countries in Asia, including China, you see very strong deflationary forces, stronger, I think, than in the United States, which might suggest that in some countries the anchoring of inflation expectations is pretty weak. One great example is Sweden, which just lowered their central bank deposit rate to minus 50 basis points. The economy's been growing at 3.5% in real terms. Inflation is about 0. And they're completely panicked about reaching their inflation target, which is the same as ours. They've been talking about foreign exchange intervention and all kinds of ways of doing things. So, is the Phillips curve dead? Well, clearly there's something in that expectations term that is not working. In Europe, the outlook is weaker than here. In Japan, the outlook is weaker than here, and it is a broad problem.
So, do you? Yes, go ahead.
More generally, I don't think it's possible in today's economy and in recent years to understand the American economy just like looking at American economic statistics. They have to be understood as conditional on what's going on in the rest of the world.
Okay, Joe, you want in on this one?
What I think is part of the issue here is related to the issue of inequality. As Ben said, the unemployment rate doesn't necessarily mean the same thing that we thought it meant, and particularly in a period where labor force participation rate is very low, the employment rate is low, that you have to ask what is going on. Part of it is that there are large numbers of people who've become discouraged workers. there are large numbers of people who are employed, but only part-time, involuntarily. And all that gives a different context to what you mean by unemployment. So there's not a surprise that given that the differences in the real economy, and I guess I would stress that differences in the real economy as driving the differences in behavior. Now, of course, those differences in the real economy may affect inflationary expectations. But I think one ought to focus on what is happening in the real economy and how that is feeding into some of the other problems that we'll be talking about.
And we will come back to that, I promise. Okay, mystery number 3, and Michael Boskin, I'm going to make you take this one because you sit on the board of ExxonMobil, and that's oil. We used to think that a falling oil price was a great thing for consumers. Now. And again, this may be a U.S.-focused view. Now we aren't so sure. Maybe globally it's a wash. But how much should we be worried about what's happening with oil prices?
Well, economists' traditional view is it depends whether it's a supply shock or a demand shock. And it's obviously been both. But the fact of the matter is we've had an immense increase in oil production capacity, and there's still more about to come on. So, the U.S., for example, added 4 million barrels a day net of the natural field declines since 2007. So that's just an immense increase, and there were similar increases in some other places. And with the sanctions lifted, the Iranians will be coming back on at some point. So there's a big supply component to this. On the effect on the American economy, I think people substantially overestimated how much of a boost to consumption it would give, and substantially underappreciated the tremendous effect it would be on American energy production, investment, and employment, because that was probably the sector that was the single most robust in the weak recovery. And then in addition, of course, you have the appreciation of the dollar. So I wrote in your former newspaper 10 months ago that the net effect would be quite small of those things.
Can I just make one more comment, which is that whenever there are large changes in relative prices, even if we were oil neutral, it has large distributive consequences. And in the short run, the adverse effects on the losers are greater than the positive effects on the winners, simply because there are asymmetries in adjustment times. So we saw this back in the 70s. When the oil price went up, it was bad for our economy. Then in the 80s, when the oil price went down, we also had a little bit of a bad patch. And that just speaks to the fact that adjustments are costly.
Maurice, you want to put, I'm sorry, Ben, go ahead.
Well, I was just going to add that relative to the 70s, our financial markets are much more globally integrated than they were before, and a lot of our perception is coming from the fact that markets are so responsive to oil prices. For the world as a whole, of course, producers equal consumers, and so they're losers and they're winners. But people are reacting first to the signs that oil price declines are suggesting slower demand growth globally. That's one possibility. Another possibility is that there are financial stresses being created in various places, and with globally integrated financial markets with risk sharing around the world, even though what's happening might be happening in Russia or in Brazil, we still feel that in our markets here.
Maurice, you want to put it in a global context?
Yeah, I'll add a CEA story. So somewhere early in 2015, we had our morning staff meeting, and Dennis McDonough, the chief of staff, the CEA has been saying this is going to be a plus for the American economy. It's going to be a good thing. And one of the things Dennis had noticed was that whenever the price of oil went down, the stock market dropped. That's an exaggeration, but it's become less of an exaggeration in the last few weeks. And so he said, well, why is that if it's such a great thing? So I wrote a memo on the 6 reasons why that would happen. It's been somewhat surprising to me how much stronger the correlation has become than when I wrote that memo. And it's really puzzling because if you look back on the 80s, we had this whole macro literature about oil shocks. And the idea was they led to stagflation because they would raise production costs and they would also increase inflation. And how was monetary policy supposed to respond? So what we've been seeing when they fall is that we get the deflation, but we haven't been seeing the benefit from lower costs of production, really. One reason for that may have to do something with being at the zero lower bound, that this is like a productivity increase and it's deflationary, and if you're at the zero lower bound and you can't ease monetary policy, it may make it harder to stabilize the economy, and people in the markets know that. Globally, there hasn't been a payoff either, because we have a lot of stressed economies. Saudi Arabia, as the price has dropped and stayed low, which is partly of their doing, has cut their government deficit from 22% to 15%. But that's a big fiscal contraction. So why is the effect so bad? Partially, I think it's because it comes at a time when a lot of commodity exporters are under pressure. And the oil story is not mainly a China story. I think the other stories are mainly a China story, but this is hitting a wide range of emerging market commodity exporters, oil and non-oil, in a way that's really deflationary.
So you've already hit on my fourth mystery, which is China, and how worried should we be about it? On the one hand, you'll sometimes hear economists say, look, our exports to China are only, 1% of GDP, not that big a deal. On the other hand, I think the extreme case was a letter that Kyle Bass, who is not an economist, I understand that, but put out to his investors yesterday saying that this is 4 times worse than the financial crisis of 2008, 2009, and it's going to require the Chinese to pour massive amounts of money to recapitalize their banking system, and will have a greater than 30% decline in the value of the Chinese currency against the dollar, with huge global consequences. So that's an extreme view, obviously, but Ben Bernanke, how big a deal is it? How worried should we be about what's happening on the other side of the globe?
Well, it's frankly, a little bit puzzling. We knew that China was going to slow down. It had to slow down. It's changing its growth model from one based on heavy industry and exports to one based more on services. We know it's no longer growing because of farmers coming to the city. There's all kinds of things that mean that China has to slow down, and moreover, that the outward-facing part of China, the part that imports commodities and trades industrial goods, that is slowing even faster than the economy as a whole. So all of that, in some sense, is not terribly surprising, but it's similar in ways to the oil issue, in the sense that while it is true that the U.S. is not directly exposed that much to trade in China, there are other countries in the world that are more exposed, including Europe, I think, more than we are. And those financial pressures are somewhat asymmetric, as Joe was suggesting. It is possible that they'll have to take strong measures to deal with some of the credit issues, for example. The good news is 2 things. One is that the Chinese government has huge amounts of resources and shown a willingness to use them when it's necessary to address, for example, banking problems. The second thing is that unlike a lot of other emerging markets, that China's debt is mostly in the domestic currency and funded by domestic savers, and so that currency mismatch risk that we saw, for example, in the Asian financial crisis is not as pronounced, I think, in China.
Yeah, I broadly agree with Ben's analysis. I think where the dangers are greatest is in the spillovers to emerging market commodity producers and those that sell machinery to China. The sector that is shrinking. China consumes 50 to 60% of the world's supply of certain metals. You look at copper, you look at iron ore, and so this has been an immense impact on the rest of the world. And it's something that really goes back, I think, to the early 2000s, that China's rapid growth, its emergence on the world scene, created a terrific demand for commodities. And during this period, investment flowed to emerging markets who invested very heavily in these sectors. They grew quickly. China's stabilization after the global financial crisis perpetuated this trend. And when that came to an end around 2011, suddenly you had a lot of emerging markets with a lot of capacity and a lot of debt whose growth model was suddenly not looking so good. And for them, the problem of adjustment to this, of diversifying their export bases, is going to be a challenge they have to deal with for many years going forward.
I'd like to make one quick comment of perspective and then give a part of an answer. That we're celebrating the 70th anniversary of the Council of Economic Advisors. We've done this halfway along at the 35th, which would have been 1980, 1981. It's almost inconceivable anybody would be talking about China. Deng Xiaoping had just started his reforms, and if one of our predecessors been up here saying, I predict at the 70th that 400 million people have been lifted out of abject poverty, and our financial markets and our multinational businesses would be deeply concerned about a slowdown in China, you would have made some very catty comments about they must be off their meds or something.
Just let me make just a couple of comments. First, I think the point that Ben made was important, that most of what is going on, there's no news. We knew there was going to be a transformation, a movement from to a domestic demand-driven, service-based economy. So I think this is again testimony to the myopia and short-sightedness of financial markets that we see over and over again. That somehow, even though they know about it, they've been told about it, when it happens, they're surprised. There are a couple of things that are, I think, that are genuinely surprised. Two things. One is, I don't think most people expected the magnitude of the monthly capital outflows out of China. Like last month, $100 billion. Those are big numbers, and even though that looked like they had a lot of reserves, if you're burning it out at that fast, it's at least something that draws your attention. The second thing is, I think there is a little bit of worry about the economic management. They've gone from a small economy, and I think Mike was absolutely right. My first trip was exactly 35 years ago, and you went there, and it's very different. In who would have predicted that they would be where they are today? It is a real miracle. But you might say they somehow solved a lot of economic problems on the way, including moving 400 or 500 million people out of poverty. But as they've gotten a larger and more complicated economy, it becomes more challenging managing it. And I think that at this juncture, there are some people, there is, in some quarters, a lack of confidence in their ability to make those management. And that may be the news that has really struck people.
I want to just make sure we understand it's not just the financial markets that are overreacting or having this big effect, but you have lots of multinationals in the United States and Europe and elsewhere that are prominent traders with China that had been expanding capacity. The oil industry expanded capacity partly in relation to this. Those are real effects. The unemployment in the oil patch, the downturn, the lost profits, and so on. Those are real effects. It's not just people trading oil futures.
No, but they should have expected some of this, because that was really the point.
Sure, I think most of them did, but it just suggests the naive extrapolation of very rapid growth rates for very long gets you in trouble, whether that's extrapolating China's growth or extrapolating the growth of the U.S. economy in 2005, 6, and 7 and housing prices to keep going up.
Okay, fifth mystery, which Joe has already referred to a couple of times, and let me say I saved it for last, not because it deserves to be last, but because I was afraid it would be the most controversial, and that is the question of inequality. Why is it getting worse, and what, from a government policy perspective, could reasonably be done to have any effect on it? And Joe, you can take this on first.
Okay. Well, we in the discussion in the earlier panels, we thought that there was a broad discussion about how mostly economists agree, but this is one area where I think there are a number of different theories, and I think economists disagree. One of the things that we did in, I think, my last or next to last CEA report is discuss inequality, which was already beginning to grow, and discuss some of the forces that were going into it, and there wasn't clarity then. So let me just discuss three alternative theories very quickly and give my own view. And they all play a role. The question is parsing out the relative importance. One of them is obviously there are some you might call conventional demand supply, relative supplies of skilled and unskilled labor. That's part of what is going on, skill buys technical change. For the most part, those theories have become either discredited or a lot less emphasis placed on them in the last 10 years. One of the reasons for that is the mystery of how it is over the last 35 years or so, productivity has roughly doubled and wages adjusted for inflation have roughly stagnated. And so that is a big gap. And 20 years ago, it was just beginning. We were aware of it, but it just continued and grew and grew. And so that suggests that something else is going on. And I think it has been a whole set of factors that affect the bargaining power of workers, the rewriting of the rules of the market economy that have allowed more scope for market power, some intrinsic changes in the structure of the economy that have led to more market power. More market power means markups are higher and therefore real wages go down, getting a smaller share of GDP. So I think those are the two of the factors. Third, Piketty, the one that Piketty emphasizes is more differential savings rates about different groups in the population. I don't think you can explain either the differences of, I don't think you can explain, for instance, the gap between productivity and wages in Piketty's explanation. And the savings implications of Piketty's model can't explain the decrease in the capital output ratio occurring simultaneously with an increase in the wealth income ratio. And that disparity is a sign of the growth of ranks in our economy, and that is more consistent with the theory that I think is responsible for the growth of inequality.
Michael?
Well, just a few quick comments. I do agree that the conventional measures of inequality have widened, but I think the single most important thing to note is they've widened almost everywhere. So it's very hard to pin a lot on what's happened in the United States. I'm fonder of the Bush tax cuts and Obamacare, but neither were the primary reasons why inequality has changed much in the United. Couldn't explain more than a small part of inequality, if any.
So why?
So let me just go on. So labor's share of income has declined almost everywhere. Another economic supposed constant, because we used to like doing examples with Cobb Douglas to our students because they were easy to solve. That was true until it wasn't. Like the saving rate constant and the ratio of female to male wages and other supposed laws. So I think it's important to understand that. I think it's also, to tie the package together, it's also important to understand that global inequality has plummeted, absolutely plummeted. And that's because of the tremendous increase in the numbers of people moving out of poverty in the developing world, China most especially.
Actually, the Gini coefficient in the world has not really plummeted.
It's fallen by more than the U.S. has increased.
Depending on how you measure it. I mean,
okay, we'll talk offline about that. Okay, we'll talk offline. I'm sure you have a measure that you think supports what you're saying. So I'll concede that if I won't concede that I would agree with the measure. In any event, so the main thing that's been going on has to be something common to all these economies, and it's primarily the combination of technology and globalization. And that is, in my moon, and also combined with what Joe kind of dismissed, that technical change has been increasingly skilled bias, something that Larry Lau and I find in our research, which we call technology has been both capital and human capital augmenting, which we call generalized solo-neutral technical change. So I think that has to be the primary explanation. There are many other things, and I'm not saying there are no things that Joe mentioned that I wouldn't give at least some role to. But I think the primary factor has to be something that's common globally.
And Michael, if it is technology and globalization, what, if anything, can you do about it?
Well, some of this, and Maury might want to speak to this more. I mean, we've known for 50 years as economists the factor price equalization theorem and so on, as other people coming up, and wages growing there. So that when we added and then we added 1 billion workers capable of producing traded goods in the global economy, and we opened up China to a lesser extent, from a not as far back, India and Eastern Europe, that was going to put downward pressure on wages in the advanced economies, and the people who have been hit the most are the people with the least skills. But what can we do about it? I think, by the way, I do not think that inequality is the main problem. I think the lack of growth of income for most people over an extended period of time, for a lot of people, a slow growth of income over a period of time is the main problem. And when I think of inequality, I distinguish 3 concerns that people have about people at the bottom, poverty primarily, concentration at the top, which one of the candidates seems to have nothing else to talk about than that, and mobility. And my new colleague Raj Chetty's studies show that mobility has not lessened in the United States. So these are issues, I'm not suggesting they're unimportant, they are, but I think we have to take a serious look and understand them and get away from a lot of the sloganeering that's out there in the real world if we're going to have effective solutions. I think the 3 most important things to do are to have an economy that grows more rapidly. We can talk about policies to do that, but that would disproportionately benefit the people who disproportionately suffer when it doesn't grow rapidly, which is people at the bottom. Secondly, I think we have to work, and this will only pay off over a span of time, greatly improve education outcomes and just skill generation outcomes. That's everything from improving trade training in community colleges to all across the spectrum, improving our K through 12 education. I think our higher education is doing a pretty good job. If you look at OECD statistics on education tests, we all know there are problems with test scores, but we're considerably below the OECD average and the mean. We're considerably above it in the low performers, and we're considerably behind it in the top performers. So maybe that will be the next crisis if we don't do something about that soon. And then the third thing I think is we need policies that wind up enabling people to transition out of dependency into the workforce. I think in a genuine attempt to cushion harm, and something that I support expanding in a downturn or when times are tough, we need a better way to transition people off that and reduce the work disincentives in our transfer payment system so we can get onto an economic ladder and then get up it. The CBO estimates that in the phase-out ranges of several transfer payment programs that many people are on simultaneously, they're paying tax rates of 100%. That's double my marginal tax rate when I include California taxes and federal taxes.
Maury, you want in on this?
Yeah, just briefly. Sort of partially agree with both previous speakers, maybe not completely. You know, the global nature of the inequality problem is very striking, and Mike brought that out. While there's been convergence in per capita incomes from poor to rich, and a lot of people have come out of poverty, you look at a lot of emerging and developing countries and you see increases in inequality. And China is a leading example. And you even see it in Japan among advanced economies, which has long been pretty egalitarian. So it is a huge global trend. I think it's related to the fact that I think it is partially about rents, that people with the kind of skills you need to succeed in this globalized economy, the elites, are extremely mobile. They can move from country to country, but others are left behind. And when growth starts to slow, the tensions become very, very strong. And that's one of the reasons that Chinese leadership is so attached to growth targets. They don't want growth to slow because even though many people in China are less poor than they were, the disparities are great. And so it's important to keep growth up. It's important to have an anti-corruption campaign. All of those things fit together. We see this very much in Europe, where the whole European project is contingent on elites being able to move from Brussels to London to Frankfurt, wherever throughout the EU, but many others are at home, immobilized, not having work, being left behind. So it is a challenge to make, a borderless European Union work, globalization work. It's not going to work politically without policies, some of which Mike mentioned, education, job training, and worrying about those who benefit relatively less from globalization.
Ben, do you want to add anything, or you want to keep your powder dry?
Just to say, these are very tectonic forces, globalization, technology, institutions, which are very hard to deflect. And they're also multi-causes, so we need lots of different things to try to ameliorate without solving the problem. There is some chance, and I guess we can't continue the discussion of this, but there is some chance that some of these forces will sort of naturally be mitigated. For example, we could only have one integration. It was said before, I think, that only one time will we have China being integrated into the global economy. When that integration is more complete, maybe some of these forces will subside.
Can I take one or two very quick questions? Way in the back. Is there a microphone there? Yes, perfect.
I'm sure you're all aware of the recent volatility now in the markets. I wanted to understand, to what extent, if any, do the markets have when the CA are making decisions? I mean, do the markets have any influence when the CA is making decisions? Ben, I'd like your perspective, specifically since you had experience with the Fed and also was involved with CEA.
Well, there's a couple of possibilities which would make you pay attention to the markets. One, of course, if you understand why the markets are behaving the way they're behaving, you take that into account. But the two other possibilities, one is that the markets know something you don't know, in which case you need to try to understand it, and perhaps, as the Fed did in September, take some time to try to understand it. Alternatively, maybe the markets are just being driven by sentiment or some other sort of ephemeral forces. But even in that case, you need to pay some attention, because that affects the markets themselves, can have independent effects on behavior and therefore on the real economy. And so, I paid more attention to markets when I was in the Fed than at the CEA, but I always paid attention to them, yes.
Let me just mention one brief episode, which was at one point the value of the dollar relative to the yen started plummeting, and there was no explanation for what was going on that we could figure out, but we became preoccupied by it. But I don't think every once in a while, Bob Rubin would make a speech about believing in the strong dollar, and we would try to explain. We felt uncomfortable that making a speech was going to change the world, but he seemed to enjoy it, and so that's we were talking before the difference between finance ministers and CEA. Anyway, I'll just stop there.
One last question.
Can I just give a quick CEA story about that?
Go ahead.
Okay, I'll tell a very quick one. It's very important to figure out, to the extent you can, and Ben had an even more traumatic time and more bigger change and a different set of responsibilities as Fed chairman. But it's very important to try to figure out what is temporary and what is permanent, what is a liquidity problem versus a solvency problem, what's going to affect some other part of the economy. I think it was earlier mentioned by Alan Kruger or I think by Alan about the auto industry and so on. So that's really important, and it's not easy to do in real time, and you're making decisions in real time. As someone said on one of the earlier panels, it's a lot easier to do that 5 years later writing a paper as an economist back in your university. So we had, when I was CA chairman, people seem to have forgotten the last set of financial crises was maybe about a third as large. It was the savings and loans in the third world debt of the money center banks, all of whom were mark-to-market insolvent at the time because of the repudiation of their Latin debt. And we did the RTC and Brady bonds. So we were in the middle of doing all this stuff, and Drexel Burnham was having trouble. And Drexel Burnham, remember, were the first to do these high-yield bonds, pejoratively called junk bonds, but helped finance some pretty impressive things that turned out really well. And they were having trouble, and there was a lot of concern about whether this would spread to the whole high-yield market and to the whole bond market. And perhaps not surprisingly, the president was getting phone calls from longtime supporters who had been financed in building industries with high-yield bonds, and they were wondering what the hell was going on. And so we had the staff of the CEA, and Alan Greenspan was then Fed chairman. His staff was doing stuff, and the SEC was doing stuff. And finally, Alan and Richard Breeden and I got together, getting rid of the staffs, And we just couldn't convince ourselves that there was anything systemic, and so we let it go. And the president agreed that was the right thing to do. But obviously, it's a very tough call to make, even when it's one particular institution and you're not aware of a bunch of other ones that may have analogous problems because they're highly leveraged or something. So it's really important to pay attention to the markets. It's also important to recall, without over-analyzing, Paul Samuelson's famous quip that the stock market predicted 9 of the last 5 recessions. So you need to be a little bit careful about the incoming and what you try to understand is signal and what's noise.
So I can't figure out which of you had your hand up first. So very quickly, let's take both questions and then we'll wrap it up.
I thought I'd come back to the question of where's CEA going in the future. And I'm thinking about the challenge of, one, there's more volatility, so things are moving much faster. And it's the yin and yang between the politicians who need quick results versus us economists who look at data and try to have a long-term assessment of it. And we're looking at the but problem. Here's all the issues, but this. Is this monster in the room? And one of those buts can be population growth, which is really declining, what could undercent the whole growth models. But I don't think we're talking about it.
Let's get the other question.
Yes, my question is really about, I'm wondering whether the CEA should think about the access to information that the consumer has when he or she makes his consumption decision. So if I go into a Walmart and I want to buy a plastic molded doll, I have 2 choices. One that might be made overseas, that's $1 cheaper. One that's made proudly in the United States is $1 more expensive. If I trace that $1 difference, I might find that in some country overseas, an 11-year-old was pulled out of his school, put in a factory filled with asbestos, so he's going to get cancer. Intellectual property was stolen from the West in order to produce that good. Dirty coal is burnt in order for the good to come out, that sort of thing. So there's externality. The same thing in the United States. Someone is going to lose their job. They happen to be living next door to me, so their house now goes into disrepair, et cetera. So right now I go into a store and I have potentially exactly the opposite information, and I make the purchase decision, and that's repeated. 66% of the global GDP, or certainly in the U.S., is based on that decision. So should we care about that? Should we find a way to have at least first or second order impacts embedded in that price? Should the CA be providing that? Should it be available for me on an app? Or should Walmart be responsible for it?
Okay, who wants to take on one or both of those questions?
Yeah, I can take on the second question. Okay. I think this is really a very deep and important issue on trade theory, which is should trade agreements restrict disclosure of information? And is the disclosure of information unfair trade provisioning? So, for instance, the question, the USTR, let's talk about a different context, USTR has had the position, I think in general, that disclosing information about GMO on vegetable, on grains, is a trade restriction. It distorts trade. Whereas a lot of people in Europe feel it's a basic right to know whether
Vermont too.
And Vermont. So that's an example. So the United States lost a WTO case where just recently, where the question about whether we could label meat as coming from a particular place, and the WTO ruled that we could not label meat because it was implicitly directing people. I think I'm more on the side of it's important to disclose any information that consumers care about, and that is more important than the strictures of trade. But it is an extraordinarily controversial issue.
And I think that sort of gets to the first question, which is what becomes of the CEA in an era of transparency and vast new amounts of data. What does the future of the CEA look like? I don't know who wants to take that on.
Well, I'll make a couple of comments. I don't think it's been exactly slow in my tenure or my friends before me, Alan, Marty, and others, Charlie, and people have come after. Maybe it's speeding up. There's a lot of global misinformation. There's information, or I say stuff, is available in real time in tremendous abundance, and a small fraction of it is actually information. But I think that a big issue that the CEA has had to grapple with since its inception is the distinction between the short and long run. Because politicians tend to live primarily in the short run. They've got to get elected. They've got to get a vote next week on in Congress to do something. They're trying to get a Supreme Court judge confirmed, and they're trading something to get a vote, et cetera. They don't have the luxury always of thinking about what's going to happen in the next 20 years. I worked for a president who often actually went out of his way to look at the longer term, and often at his own, knowing it would be at his own political cost. I'm sure others worked for presidents who felt they did the same. But the point is that it's much harder to get people interested in the administration, and especially on Capitol Hill in the Congress, in something that's going to roll out a lot of benefits down the road, and to avoid being worried about something that's going to pose a lot of costs way down the road because of their myopic evaluation of costs and benefits. Many people say it's the length of time between now and the next election. For most people, I would add to that in my dealings with Congress over the years, it's also anything out of the jurisdiction of their committee or subcommittee is considered not germane. And I think that's a really important thing because in economics, most of our theories, some try to make a distinction. Most of our theories try to figure out how to relate the short to the long run. And obviously, the long run is the unfolding of the short run compounded over time. So I think that's really important. That distinction also is a big part of the disagreement about some fundamental things like the efficacy of short-run fiscal stabilization and things of that sort. So I think the CA will always have a role to play in trying to bring that perspective. I think it's one of the few places in the government that does that, sometimes with the assistance of other agencies. But I also think that the CEA is just going to have to adapt to the changing world, and I see no reason to expect it not to be able to adapt as other institutions may be able to. Our successors will have grown up in a world where they've been using social media since the age of 1, and et cetera, et cetera, et cetera.
Joe, let's see what you can do in 60 seconds.
Okay, 3 points in 60 seconds. First, first, I just want to second one of the points that Mike made. One of the things that, in clarifying short run versus long run, is, for instance, the accounting question of cash versus accrual accounting. One of the big things in the war accounting under, in the Iraq War, was that we didn't do a very good job of accounting for the costs that we're going to be accruing, the $1 trillion that we are going to have to spend just on disabilities of that war. So that's an amazing number. Second point, that one of the roles that the CEA can play has always played is clarifying trade-offs. And this is sort of where you're almost nonpartisan, that you want to know what are the trade-offs and what are the uncertainties about the trade-offs and why there are these uncertainties in the trade-offs. Because I always felt, if the president is going to hear all the different sides, and he's going to want to know why there are these different views. So I think that's a very important role for the president, just in the role of education. Third, just to pick up a point that Alan Greenspan made in his first remark, he was talking about the difficulty of getting accurate data. One of the things that is going on, the big data, is that there are now there are people who claim that they can get moment-by-moment readings of GDP by scraping the internet, and that those minute-by-minute readings of GDP, one of my students is actually says she does this.
What does her advisor think?
It shows me how it goes, but are as or more accurate than the first release of the GDP numbers in terms of the prediction of what really happened in the second and third release. So at least it may be going forward that the CEA will be even more relevant.
Great. Thank you. Thank you. Please join me in thanking this panel and welcoming for some. So you guys can get up. Yep. Because otherwise, Jason is going to give some concluding remarks, and I'm afraid otherwise you'll get rebuttals if I let them stay up here. After Jason finishes, I wondered if all the CEA chairs could come up so we can get some photographs, and the rest of you are welcome to hit the bar before the CEA chairs do. Jason Furman.
So thank you so much. It was a real treat listening to three of the best journalists and ex-journalists ask 3 hours worth of questions, none of which I had to answer. And I thought I'd summarize, but the danger of summarizing is that you get into the situation where everything's been said, but not everyone has said it. And I pretty much agree with everything that's been said, but thought maybe I'd use the last few moments here to challenge some of those propositions and put forward 4 alternative contrarian propositions about the Council of Economic Advisors. The first proposition I wanted to argue is that the Council of Economic Advisors is not needed. Today's session actually provided some of the most definitive proof of that proposition that we have to date, and that came not out of any of the discussions, but the randomized experiment we ran today when all of our members, all of our staff were here, and the Dow rose 98 points since we arrived at 2 p.m. So the rest of them are doing just a great job on the economy in our absence. But more importantly, this is something I tell our staff in staff meetings, that they don't actually need us. They can put out the budget without us having signed off on it. They can put out a tax policy. They can put out a regulation. We don't publish those things. No one says, unless you've signed on the dotted line, that's not going to go out. And I think in many ways that's a big advantage of CEA, that we have to live by our wits. We have to be a bit scrappy. We have to show where we can add value. We have to persuade people. We have to show how we can be relevant. And that happens on a wide range of issues. On the topic of criminal justice, for example, that was an issue that we weren't involved in, and member of our team, Emily Weisburst, and our member Sandy Black wrote a memo. We sent it to some people. They thought it was really interesting. They gave it to the president. He talked to the attorney general about it, and we became part of that conversation. And that wasn't because they weren't allowed to have that conversation without us. It's because they thought, maybe we actually, because we knew how to look at numbers and think about means versus medians, that had something to add. The second proposition is one that I might get in even more trouble for, is there's been all sorts of things about all the different things economists know and all the wisdom of economists. I think, to go out on a limb, economists don't know everything. And there's lots of things we don't know. We don't know, or at least I don't know, what GDP growth will be in the next quarter. We're halfway through this one. We don't know exactly what it is in this one. And the last estimate we had for the last quarter was 0.7%, and the only thing I know is that growth in the last quarter was not 0.7%. We'll eventually find out exactly what it was. Economists also don't know things for other reasons. Between Joe, Austin, Glenn, and Marty, we have the absolutely perfect, optimal plan to reform our tax system. We just don't know which one of the 4 of them it is that has that plan, and we could argue an awful lot about that. But I think some of the most interesting things we don't know are just things that have come up recently in the economy, novel policy questions, things people haven't put their mind to. And what economics may have is some discipline in terms of, addition and subtraction, in terms of understanding incentives, in terms of tools, like time series econometrics. A good example of this was the renewable fuel standard. And one of the most impressive things any of you could ever see is what happens when you take a policy like that, which had been mired in all sorts of interest groups and politics and who knows what, and then you add Jim Stock, MATLAB, and I think about 3/4 of the CEA staff for a 6-month period of time to the question, and how much of a better answer you come out with. We had a similar experience with the labor force participation rate, that there'd been economic research on it, but economic research tends not to be up to the minute, tends not to be thinking about what you're dealing with right then. and trying to really catch up, almost month by month, looking at the numbers, a little bit revising your views, doing some combination of literature review, original analysis, watching the data, and using that to help inform what's going on and recommending policies that we've done in areas like childcare, paid leave, and the taxation of secondary earners. So I think not understanding everything is one of the things that's really exciting. If all CEA did was take really obvious truths and repeat them over and over again in meetings and then lament that sort of, even though you repeated it over and over again in meetings, people didn't listen to you, that wouldn't be that interesting. I think it's figuring some of these questions out and muddling through and doing some combination of what you can take from the literature, what you can take from the recent data, how you can apply it in novel situations that, for me, makes the job really exciting. Which brings me to my third point, which is going out even further on a limb, which is that there are actually other people in the government who don't work at the Council of Economic Advisors who know things. You find them, I'm a little bit biased having worked in another part of the government before, but you see that on the policy side. There's a huge amount of expertise on policy, even in the White House, places like the NEC and the DPC, the Treasury, OMB, the agencies throughout government. One of the great things, I think, is a lot of the problems we deal with aren't sort of rivalrous turf, whose equity is what. It's a hard problem, trying to understand, why the labor force participation rate is falling and what to do about it, to use that example. And getting a bunch of heads together from different places can help do that. And you see economists bonding in some ways, as Marty alluded to, across the government, but you see, economists and non-economists trying to figure it out. The other thing that people know is they know an awful lot about politics, legislation, communication, groups, and all sorts of things. And that's really relevant, too. The perfect idea doesn't count for anything if you can't pass it through Congress. And President Obama is very much of the mind that he wants his advisors to stay in their lane. And every time I'm, tempted to jump out of my lane and offer all sorts of legislative, political, and communications advice, I then briefly think about what I would think about if the legislative, communications, and political person was jumping into my lane, and think, it's all for the better if the president is the one that takes all of that and figures out how to integrate it. In a lot of ways, that's really liberating. It means that we can come to the table and give unvarnished economic advice. That doesn't mean, when you give option A, B, and C, and A was better than B, that you're really bitter if the choice was B. If A could never have happened, B can pass Congress. That is a perfectly great thing to have happened. But it means you don't need to encumber yourself with all of the same considerations. Then the last point I wanted to make, maybe the most contrarian of all, is that I think good things can come out of Washington. They can come out of Washington in part based on economic and policy analysis. And the only caveat to that whole thing is sometimes you need to be a little bit flexible in terms of how you define good. Just this past year, we had allusions before to, things used to happen decades ago. Now the system's entirely, broken. Just this past year, we had worked together with the people from other parts of the government that know a lot too, to help design and put in last year's budget some reforms to the sustainable growth rate for Medicare, which is the doc fix, which had been going on for decades, of this pay cut for doctors. It happened abruptly, and sort of everyone lamented it as a policy. Everyone dealt with it 3 months at a time, a year at a time. This year, bipartisan legislation not just fixed the doc fix, but did it in a way that will lead to better coordinated care, better payment for value, and shifting to the alternative payment models that are a broadly shared goal for the future of the health system. We saw an infrastructure bill, a budget agreement, and a tax agreement, none of which were the first best from anyone's lights, but all of which to different degrees were informed by economic analysis, that both that analysis and advocacy that explains that economics to people help make all of those things happen. I have a long list of things that didn't happen in the last year. Would love to see some of them get done this year. Would love to see some of them get done the year after that. Weeding out the bad ideas is an important part of the process. But for me, the most exciting thing is when you can, work on one of those good ideas, figure out how to explain why it's good, and help make it happen. And so for me, it's a little bit less the pulling up weeds or planting seeds or whatever it is, than planting 20 different seeds and being really excited when you see 3 of them grow up, and hoping maybe some of the other 17 eventually do too. So I think today has been a great discussion. You've seen both substance and trying to understand some of the process of economic policy. And so I'd like to thank everyone for being here today for that discussion, and everyone who's taught me so much throughout my career and today as well. So thank you.